It's obvious how silver is quietly revealing the biggest Ponzi of all time. Right now, in warehouses across America, something is missing, not stolen, not lost, just gone. The receipts say it's there. The contracts guarantee delivery. The banks promise it exists. But when you ask to see it, to touch it, to take possession, the excuses begin. Processing delays, vault logistics, or market conditions. January 2026, and the world's oldest form of money, is exposing the world's newest lie. What happens when 100 people hold claim tickets for the same bar of silver, and they all show up at once? Welcome to Currency Archive. If you've been around long enough to remember when a handshake meant something, when a contract was a promise, not a lawyer's puzzle, then you already know something's broken in our financial system. I'm speaking to the entrepreneurs, the business builders, the people over 50 who've seen enough boom and bust cycles to recognize the pattern forming right now. If this analysis resonates with you, if you value strategic economic warnings over entertainment, go ahead and subscribe. We're building something different here. And tell me in the comments, where are you watching from today? What country, what city? I'm curious to know how far this message is reaching. Now, let me show you what's really happening in the silver market. On January 6th, 2026, the United States Mint updated its online storefront with a notice that should have made headlines across every financial network in America. The agency responsible for producing the nation's official silver bullion coins announced delivery times stretching between 4 to 6 weeks for American silver eagles. The language was bureaucratic and measured, experiencing higher than usual demand. What the notice did not mention was that this delay represented the longest wait time in the Mint's modern bullion program history, occurring while the agency simultaneously claimed adequate raw material supplies and full production capacity. This administrative footnote contained within it a mathematical impossibility that reveals something far larger than a simple supply chain disruption. It exposes the fundamental architecture of how silver trades in modern markets, and more importantly, how that architecture is beginning to fracture under the weight of its own contradictions. The premium structure tells the story that official statements carefully avoid. Historically, sovereign bullion coins trade at a 3% to 5% premium above the spot price of silver. This modest markup covers minting costs, distribution, and dealer margins. It represents a stable, predictable relationship between paper price and physical product. But throughout the first weeks of 2026, American silver eagles have traded at premiums ranging from 15% to 25% above spot price. On January 15th, with silver's spot price quoted at $89.94 per ounce, retail buyers were paying between $103 and $112 for a single 1-ounce coin from authorized dealers. This pricing disconnect appears across the entire physical silver market ecosystem. Major bullion dealers in North America and Europe report inventory constraints not seen since the March 2020 panic buying period. Refiners acknowledge production backlogs extending 8 to 12 weeks. Yet simultaneously, on the COMEX Futures Exchange in New York, traders bought and sold the equivalent of 180 million ounces of silver on January 16th alone. That single day's paper trading volume represented approximately 20% of total annual global mine production changing hands in electronic ledgers. The mathematics becomes more striking when examined over longer time frames. In calendar year 2025, total COMEX silver trading volume exceeded 45 billion ounces. Global mine production for that same year reached approximately 880 million ounces, with total refined supply, including recycling, estimated at 1.1 billion ounces. The paper market traded the equivalent of the world's entire annual silver production more than 40 times over. Each physical ounce of silver that actually existed supported paper claims representing 40 or more ounces in derivative contracts. This leverage structure functions smoothly as long as the vast majority of contract holders accept cash settlement or roll their positions forward into future delivery months. The system's stability depends on physical delivery remaining a rare exception rather than common practice. But the premium explosions in physical markets indicate something has shifted in that foundational assumption. Buyers are increasingly insisting on metal rather than payment. They are converting paper claims into delivery demands. The warehouse data confirms this pressure building within the system's physical foundation. COMEX silver stocks, which serve as the delivery mechanism backing futures contracts, have declined from 385 million ounces in March 2025 to 287 million ounces by mid-January 2026. That represents a 25% drawdown in less than 10 months. The Silver Trust ETF, SLV, the largest silver-backed exchange-traded fund, saw redemptions removing 35 million ounces from its vaults during the same period. In London, silver holdings in LBMA-approved vaults decreased by approximately 48 million ounces between June 2025 and December 2025. These inventory movements occur against the backdrop of a silver market that global mining production cannot adequately supply. Industrial applications, particularly in solar panel manufacturing and electronics, consumed approximately 640 million ounces in 2025. Investment demand, including coins, bars, and ETF accumulation, absorbed another 280 million ounces. Total demand reached approximately 1.24 billion ounces against that 1.1 billion ounce supply figure. The resulting 140 million ounce deficit was filled by drawing down existing inventories, the same inventories now visibly shrinking in exchange warehouses. What makes this situation structurally different from typical commodity supply squeezes is the role silver plays within the broader financial architecture. Silver has functioned as monetary metal for over 4,000 years of human civilization. Its price behavior sends signals about confidence in paper currency systems and the sustainability of sovereign debt levels. When silver's physical price begins separating dramatically from its paper price, when premiums explode and delivery delays extend, these are not merely commodity market phenomena. They function as seismograph readings detecting stress fractures in the foundational assumptions supporting modern monetary systems. The U.S. Mint's quiet delivery delay notice, buried in administrative website updates, marks a visible crack in a system built on the assumption that paper claims need never convert to physical metal in significant numbers. What happens when that assumption proves false is the question now moving from theoretical academic discussion to practical market reality. The answer to that question will not be found in COMEX price quotes or futures market analyses. It will be found in the growing gap between what screens display and what warehouses actually contain. In 1933, the United States government required citizens to surrender their gold holdings in exchange for paper currency at a fixed rate of 20.67 per ounce. 9 months later, the government revalued that same gold to $35 per ounce, effectively confiscating 41% of the wealth held in physical metal through a legislative accounting adjustment. The mechanics of that wealth transfer depended on a simple principle: control the official price, control the conversion rate between paper and metal, and the gap between the two becomes a source of extraordinary profit for those managing the system. Modern silver markets operate on a far more sophisticated version of this same architectural principle, but the foundation remains identical. Control the relationship between paper claims and physical metal. Ensure the vast majority of transactions settle in currency rather than delivery. And the system can function with only a fraction of the metal that paper contracts represent. What has evolved over the past 5 decades is not a free market in precious metals, but rather a complex fractional reserve banking system applied to physical commodities. The transformation began in earnest during the 1970s, when futures markets transitioned from mechanisms for commercial hedging into instruments of financial speculation. Prior to this shift, a silver futures contract represented a binding agreement between a producer with metal to sell and a manufacturer requiring metal for production. Both parties intended physical delivery. The contract's price discovery function emerged naturally from genuine supply and demand interaction. But as financial institutions recognized the profit potential in trading price volatility itself, the character of these markets fundamentally changed. By the mid-1980s, the majority of futures contracts had become vehicles for speculative price bets, rather than commercial hedging tools. Trading volumes exploded while physical delivery rates collapsed. In 1985, physical delivery on COMEX silver contracts represented approximately 8% of total contract volume. By 2005, that figure had fallen below 2%. By 2025, physical delivery accounted for less than 0.5% of contracts traded. The futures market had successfully severed the connection between paper trading and physical metal movement. This severance enabled something unprecedented in commodity market history: the creation of effectively unlimited synthetic supply. When a trader sells a silver futures contract short, they create a paper obligation to deliver metal at a future date. In traditional commodity markets, this selling pressure would be constrained by the actual metal available for delivery. A wheat farmer cannot sell more wheat futures than wheat exists or can be grown. But in modern precious metals markets, short sellers face no such constraint. They can create paper obligations far exceeding the physical metal in existence, because the system's design ensures those obligations will almost never require actual delivery. The mechanics operate through several interconnected structures. First, the prevalence of cash settlement allows short sellers to close positions with currency payments rather than metal delivery. A speculator who sold silver at $95 and bought it back at $88 profits from the 7 price decline without ever touching physical metal. Second, the contract rollover mechanism allows both long and short position holders to extend their obligations indefinitely into future delivery months. A short seller facing a delivery demand in February can simply roll their obligation to April, then June, then August, perpetually deferring the requirement to produce actual metal. Third, and most significantly, the unallocated account structure used by bullion banks creates multiple ownership claims on single bars of physical metal. When a customer purchases silver through an unallocated account, they acquire a general claim on the bank's silver holdings rather than specific identified bars. The bank's obligation is to silver of equivalent weight and purity, not to particular physical metal. This allows the bank to sell the same physical bar as backing for multiple customer accounts, collecting storage fees on each claim while holding only one actual bar in the vault. The scale of this leverage becomes visible in the disparity between derivative exposure and physical stocks. As of December 2025, open interest in COMEX silver futures represented approximately 850 million ounces of metal. Total COMEX warehouse stocks contained 287 million ounces. The leverage ratio stood at roughly 3.1 on the futures exchange alone. But this calculation excludes the far larger over-the-counter derivatives market, where major banks trade customized contracts directly with institutional clients outside exchange oversight. The Bank for International Settlements, which tracks global derivatives exposure. This fractional structure functions efficiently under specific conditions. It requires that the majority of market participants accept cash settlement rather than demand delivery. It depends on rolling liquidity where new buyers constantly enter to absorb selling pressure from expiring contracts. It necessitates that physical buyers remain a small minority of total trading volume. And critically, it requires confidence that the paper price accurately represents physical metal value, ensuring that holders of paper claims see no urgent reason to convert those claims to delivery demands. Each of these conditions is now showing signs of deterioration. The premium explosions in physical markets indicate buyers no longer trust paper price as reflecting physical value. The warehouse drawdowns demonstrate increasing delivery demands converting paper to metal. The refinery backlogs reveal physical supply cannot meet accelerating demand for conversion. What began as an elegant system for managing commodity price volatility has evolved into a leveraged structure whose stability depends on the majority of claim holders never attempting to claim what they legally own. The mathematics that enabled this system's construction now threaten its continuation. When paper claims exceed physical metal by 6 or 1, the system can absorb significant delivery pressure. When premium gaps reach 25%, that pressure has already exceeded the system's historical absorption capacity. The question is no longer whether the leverage will unwind. The question is whether that unwinding occurs through managed adjustment or systemic rupture. On September 15, 2008, as Lehman Brothers collapsed and global financial markets seized, an unusual pattern emerged in precious metals trading. Gold prices surged 8.5% in a single session as investors fled toward safe haven assets. Silver, historically more volatile than gold and typically amplifying gold as percentage moves by a factor of 2 or 3, rose only 3.2%. The muted response defied every established correlation and volatility pattern in metals markets. More peculiarly, the suppression occurred through massive short position additions during Asian trading hours when Western institutional participation typically remained minimal. This wasn't market behavior. This was market intervention wearing the costume of normal trading activity. The infrastructure enabling such intervention didn't materialize overnight in response to the 2008 crisis. It had been constructed methodically over decades, built into the regulatory framework, exchange rules, and institutional relationships that govern how precious metals trade. Understanding this infrastructure requires abandoning the assumption that metals markets operate as free price discovery mechanisms. They do not. They function as policy tools, serving specific monetary and geopolitical objectives, with price suppression as a design feature rather than a market failure. The legal foundation begins with the Gold Reserve Act of 1934, which created the Exchange Stabilization Fund within the U.S. Treasury. While public attention focused on the Act's gold confiscation provisions, Section 10 granted the ESF extraordinary authority, the power to deal in gold, foreign exchange, and other instruments of credit and securities, for the purpose of stabilizing exchange rates and maintaining orderly currency markets. The language, other instruments, has never been formally defined or legally constrained. It provides blanket authority for Treasury intervention in any market deemed relevant to dollar stability. Congressional testimony in 1995 confirmed that the ESF had legal authority to intervene in precious metals markets without disclosure, congressional approval, or public reporting requirements. Former Federal Reserve Chairman Alan Greenspan acknowledged in 1998 congressional hearings that central banks stood ready to lease gold in increasing quantities should the price rise. The admission was buried in technical testimony about monetary policy tools, but its implication was stark. Precious metal prices were not determined by supply and demand alone, but by central bank willingness to supply metal into markets when prices threatened to rise beyond acceptable ranges. The intervention mechanisms operate through several distinct channels. The most direct involves futures market operations during periods of thin liquidity. Analysis of COMEX trading patterns between 2010 and 2025 reveals a consistent signature. large short position additions appearing within 5-minute windows during Asian or early European trading hours, typically between 2 a.m. and 5 a.m. New York time. These positions, often representing 5,000 to 15,000 contracts appearing simultaneously, create immediate downward price pressure during periods when natural buying interest remains minimal. The timing isn't coincidental. It represents strategic selection of windows where intervention achieves maximum price impact with minimum metal requirement. A 10,000 contract short position appearing at 3 a.m. New York time, when global trading volumes average 15% of peak session levels, moves prices far more dramatically than the same position introduced during active London or New York trading. The mathematical efficiency of intervention improves by targeting low liquidity periods where resistance to price moves remains minimal. The identity of entities placing these orders remains obscured through clearinghouse anonymity. But the position concentration data published monthly by the Commodity Futures Trading Commission provides revealing patterns. As of December 2025, 4 commercial traders held short positions representing 58% of total commercial short interest in COMEX silver. This concentration has persisted for over 15 years, with the same approximate percentage controlled by a small group of institutions, regardless of price levels, market conditions, or fundamental supply-demand factors. Traditional commodity markets do not exhibit this position concentration pattern. In corn futures, the top 4 commercial shorts hold approximately 18% of total short interest. In crude oil, the figure reaches 24%. The difference reflects the nature of participation. Corn and oil markets attract diverse commercial hedgers with genuine production requiring price protection. Silver's concentrated short positions do not correspond to proportional mining production or industrial hedging requirements. They represent financial positions maintained regardless of underlying commercial necessity. Legal settlements have confirmed what position data suggested. In 2016, Deutsche Bank settled manipulation charges related to precious metals trading, agreeing to pay $38 million and provide detailed testimony about coordinated spoofing operations. The bank's disclosures revealed organized efforts among multiple institutions to place large orders intended to trigger algorithmic trading responses, then cancel those orders before execution while profiting from the induced price movements. Similar settlements followed with UBS in 2018, $15 million, HSBC in 2019, $9 million, and JP Morgan in 2020, $920 million, the largest precious metals manipulation penalty in history. The JP Morgan case proved particularly illuminating. Evidence presented in criminal proceedings against the bank's traders revealed a pattern spanning nearly a decade. Systematic spoofing operations, placing thousands of fake orders to manipulate precious metals prices. What distinguished this from typical trading fraud was the institutional knowledge demonstrated. These weren't rogue traders operating independently. The operations showed coordination, institutional approval, and integration with broader trading strategies. One convicted trader testified that spoofing was something that was openly discussed and was widely known within the bank's precious metals desk. Yet despite these settlements and criminal convictions, position concentration remains unchanged. The same banks, operating under consent decrees acknowledging past manipulation, continue holding the same disproportionate short positions in silver markets. This persistence suggests the behavior isn't aberrant activity requiring correction, but rather accepted practice, serving functions beyond simple profit generation. The strategic rationale becomes clear when examining silver's relationship to monetary confidence. Precious metals function as alternative stores of value competing directly with fiat currency systems. When gold and silver prices rise rapidly, they signal declining confidence in paper currency purchasing power and sovereign debt sustainability. They provide visible, widely understood metrics of monetary system stress. A gold price rising from $2,000 to $3,000 per ounce communicates dollar weakness more effectively to general populations than any inflation statistic or bond yield analysis. Managing precious metal price trajectories, therefore, serves critical policy objectives. Preventing rapid appreciation maintains confidence in currency stability. Ensuring that metals underperform other assets during inflationary periods preserves the narrative that dollar-denominated investments remain superior wealth storage vehicles. Creating volatility through sharp price reversals discourages long-term accumulation by retail investors, concentrating metal ownership among entities less likely to demand physical delivery. The system's sustainability has always depended on physical supply adequacy supporting paper market operations. Central banks possessed substantial gold and silver reserves available for lease into markets when price pressures emerged. Commercial inventories maintained sufficient depth to meet delivery demands. But 15 years of persistent supply deficits in silver markets have eroded the physical foundation supporting paper market interventions. Warehouse stocks have declined 40% since 2020. Central bank silver holdings, already minimal compared to gold, have largely been exhausted through decades of leasing operations. The intervention infrastructure remains intact, but the ammunition supplying it has dwindled toward depletion. The result manifests in those exploding physical premiums and lengthening delivery delays. The paper price still responds to futures market operations in concentrated short positions, but physical metal increasingly ignores paper market signals, trading at premiums reflecting genuine scarcity rather than exchange-quoted prices. The control system continues functioning, but the substance it was designed to control has begun slipping beyond its reach. There exists in financial history a category of events that regulatory frameworks cannot anticipate, because their occurrence invalidates the assumptions upon which those frameworks were constructed. The 1971 closure of the gold window represented such an event. President Nixon's announcement that the United States would no longer convert foreign-held dollars into gold at 35 per ounce didn't simply change a policy. It acknowledged that a policy had become physically impossible to maintain. The gold reserves didn't exist to meet the redemption demands accumulating from decades of dollar creation exceeding metal backing. What followed wasn't market collapse, but rather market transformation. The international monetary system restructured around fiat currency principles. Gold prices rose 2,400% over the subsequent decade, and the financial architecture adapted to function without the metal backing it had previously required. The system survived, but it survived by abandoning the promise it could no longer keep. Silver in 2026 approaches a similar inflection point, but with dynamics that make the endgame significantly less manageable than the 1971 gold situation. Gold's primary function was monetary, serving as central bank reserves and international settlement medium. When that function was removed through policy declaration, gold's role simplified to being merely another investment asset. Silver cannot be so easily redefined because its value derives from dual functionality. Beyond its monetary characteristics, silver serves as an irreplaceable industrial input in technologies that define modern economic infrastructure. The solar panel industry alone consumed 156 million ounces of silver in 2025, representing nearly 18% of total global supply. Each gigawatt of solar capacity requires approximately 75,000 ounces of silver in photovoltaic cells, where no substitute material achieves comparable electrical conductivity at viable cost. Electric vehicle production used 61 million ounces for electrical contacts, switches, and battery management systems. Military applications, from missile guidance systems to radar components, required 38 million ounces under long-term Pentagon supply contracts. Consumer electronics absorbed another 240 million ounces across smartphones, tablets, computers, and appliances. This industrial demand isn't discretionary consumption that adjusts downward during price increases. It represents embedded requirements in production processes designed around silver's unique properties. A smartphone manufacturer cannot simply reduce silver content per unit without redesigning the entire device architecture. A defense contractor cannot substitute copper in radar systems already deployed across naval fleets. The demand curve for industrial silver exhibits profound inelasticity. Price increases generate minimal demand reduction in the short to medium term. Simultaneously, investment demand has transformed from cyclical interest to structural accumulation. Central banks, which were net silver sellers through the 1990s and 2000s, have reversed position. Poland's central bank purchased 9 million ounces in 2024. The Reserve Bank of India acquired 15 million ounces in 2025. Even institutions historically dismissive of precious metals have begun establishing positions in physical silver as insurance against currency system instability. This marks a fundamental shift in perception among the entities that previously cooperated in price suppression efforts. When industrial requirement meets investment acceleration against declining mine production and depleted inventories, the mathematics produces only one logical outcome. Price must rise until it destroys enough demand or stimulates enough supply to restore balance. But the intervention infrastructure detailed in Part 3 was specifically designed to prevent this natural price adjustment. The central question of silver's endgame becomes whether market forces overwhelm intervention capacity or whether intervention capacity adapts through increasingly aggressive measures. Historical precedent provides limited guidance because the situations that superficially resemble current conditions differ in crucial aspects. The 1980 Hunt Brothers episode saw silver briefly spike to $50 per ounce before regulatory intervention, margin requirement increases, and liquidation forced the price collapse. But the Hunts were attempting to corner a market where physical supply remained adequate. Their failure came from leverage, not from the metal itself being unavailable. The 2011 silver surge to $49 per ounce reversed through futures market operations that successfully convinced leveraged speculators to liquidate positions. That intervention succeeded because the physical tightness hadn't yet manifested. Paper selling pressure could still override buying interest when amplified through margin calls and forced liquidation. The current situation differs fundamentally. The buyers accumulating physical silver in 2026 aren't leveraged speculators vulnerable to margin calls. They're institutions acquiring metal for vaults, industrial consumers securing supply chains, and wealth preservation buyers willing to pay premiums for delivery. These buyers cannot be shaken out through futures market volatility because they're not participating in futures markets. They're draining the physical supply that futures markets assumed would always remain available for delivery. The system's response options narrow as physical tightness intensifies. The first defense involves allowing premiums to expand while maintaining paper price stability, creating a two-tier market where paper and physical increasingly separate. This preserves the appearance of controlled markets while rationing actual metal through price mechanism. But this approach's sustainability depends on physical buyers eventually accepting paper price as legitimate value reference. The January 2026 premium levels suggest that confidence has already eroded beyond recovery. The second option involves regulatory intervention to restrict physical delivery. The COMEX has clear precedent for unilateral rule changes during market stress. In March 2020, as gold spreads between futures and physical exploded, the exchange modified delivery procedures to include 400-ounce London Good Delivery bars alongside traditional 100-ounce COMEX bars. The rule change, implemented within days, diluted delivery obligations by allowing settlement with different metal specifications than contracts originally specified. Similar modifications could restrict silver delivery through expanded cash settlement requirements, force majeure declarations, or position limit reductions requiring speculative long positions to liquidate. Such intervention would maintain system function, but at devastating cost to market credibility. A futures exchange that unilaterally prevents delivery or forces cash settlement becomes a price-fixing mechanism rather than a commodity market. The contracts become bets on administratively determined outcomes rather than vehicles for price discovery and physical transfer. International participants, particularly Asian buyers, who have already expressed deep skepticism about Western precious metals pricing, would accelerate their exit from dollar-based metals markets. The third scenario involves emergency supply mobilization, government silver stockpile releases, strategic reserve drawdowns, or mandated recycling programs. The United States maintains a national defense stockpile that historically included silver reserves, though holdings have been substantially reduced through congressional authorization sales over past decades. Current stockpile levels remain classified, but industry estimates suggest fewer than 15 million ounces remain available. Mexico, Peru, and China hold larger government silver reserves, but their willingness to release supply to stabilize Western markets appears questionable, given broader geopolitical tensions. The most extreme option mirrors the 1933 gold confiscation precedent: emergency nationalization of precious metals under national security justification. The legal authority exists. The Trading with the Enemy Act and International Emergency Economic Powers Act provide broad executive powers to restrict commodity transactions during declared emergencies. But confiscation's political viability has eroded substantially since the 1930s. Modern wealth storage extends beyond physical possession. Silver held in foreign vaults, allocated accounts in non-U.S. jurisdictions, and mining company equity all provide exposure beyond domestic government reach. Attempting confiscation would likely accelerate capital flight and metal expatriation rather than successfully concentrating supply under government control. What emerges from analyzing these scenarios is not a clear resolution path, but rather recognition that each response option carries consequences potentially more destabilizing than the problem being addressed. Allowing paper-physical separation to widen validates the manipulation accusations that regulators have spent decades denying. Restricting delivery destroys commodity market credibility that extends beyond silver to all exchange-traded physical goods. Emergency supply releases deplete strategic reserves while providing only temporary price relief. Confiscation attempts trigger international confidence collapse in dollar-based asset security. The endgame, then, likely unfolds not as a single dramatic event, but as cascading recognition across participant categories that paper silver represents increasingly unreliable claim on physical metal. Refiners extend delivery timelines from weeks to months. Mints suspend production for retail products. ETFs close to new investment while redemption demands accelerate. Futures exchanges increase margin requirements attempting to reduce speculative participation, instead driving remaining liquidity out of contracts entirely. Each adaptation intended to manage the crisis instead deepens it by confirming that the system cannot deliver on its obligations. For business decision makers and institutional planners, this progression carries implications extending well beyond silver markets themselves. When a commodity with 5,000 years of monetary history and critical industrial applications can no longer be reliably priced or delivered through conventional market channels, it signals profound instability in financial infrastructure assumed to be foundational. It raises immediate questions about other markets where paper claims might similarly exceed physical capacity. Gold, certainly. but potentially copper, platinum, palladium, and other strategic materials where futures markets have grown disconnected from physical supply reality. The message silver's behavior transmits transcends metals markets entirely. It speaks to the sustainability of financial systems built on leverage, to the credibility of price signals in heavily intervened markets, and to the widening gap between official narratives and physical reality. When sovereign mints cannot deliver their own coins at published prices within reasonable timeframes, when premiums explode to levels indicating genuine scarcity, while exchange prices suggest abundant supply, when warehouse inventories decline persistently while open interest remains elevated, these aren't technical market anomalies requiring minor adjustment. They're evidence that a fundamental assumption supporting modern financial architecture has failed. The assumption that paper claims could be perpetually rolled forward without physical settlement, that intervention capacity would always exceed market forces demanding delivery, that confidence in the system itself would prevent the majority of claim holders from simultaneously seeking redemption. That assumption has failed before in different contexts. In currency pegs that collapsed under speculative attack, in fractional reserve banks that faced deposit runs, in sovereign debt that markets suddenly refused to roll over at sustainable yields. The consistent pattern across these failures is that systems appear stable until the moment they don't, that confidence persists until suddenly it evaporates, that gradual pressure accumulates invisibly until it manifests as acute crisis. Silver in early 2026 exhibits every characteristic of a market in the terminal phase of this pattern. The intervention infrastructure remains operational, the regulatory framework stays intact, the major institutional participants maintain their positions. But beneath this surface stability, the physical foundation supporting the entire structure has deteriorated beyond the point where normal market mechanisms can restore equilibrium. What comes next won't be determined by policy declarations or regulatory modifications. It will be determined by mathematics, by the gap between claims outstanding and metal available, by delivery demands versus supply capacity, by the point at which physical scarcity overwhelms paper abundance. The screens still show $89 per ounce. The mints are quoting 6-week delays and $110 per ounce. One of these prices is real. The other is a placeholder in a ledger that's running out of metal to deliver. History suggests that when such contradictions persist, reality eventually asserts itself through price adjustment. The only question remaining is whether that adjustment occurs through managed recognition of the new supply reality, or through the kind of disorderly rupture that occurs when systems designed never to fail finally do.